What if I told you that a single institution, created over a century ago in secrecy on a private island, now controls the financial destiny of billions of people worldwide? Every time you check your savings account, apply for a mortgage, or watch the stock market fluctuate, you're feeling the ripple effects of decisions made in a fortified building in Washington, D.C. The Federal Reserve isn't just America's central bank. It's the puppet master of global finance, capable of triggering economic booms or devastating crashes with a simple announcement. Today, we're exposing how this powerful entity really works and why its influence reaches far beyond American borders. Picture this. It's 1907, and America is in the grip of a financial catastrophe. Banks are collapsing like dominoes. Panicked customers are storming bank doors demanding their money, and the entire U.S. economy teeters on the edge of total collapse. It took one man, J.P. Morgan, to literally bail out the nation by organizing private financiers to provide emergency liquidity. But this terrifying episode exposed a fundamental truth. America needed a permanent solution to financial instability. 6 years later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law, creating the most powerful financial institution the world has ever known. What started as a desperate response to banking panics has evolved into something far more complex and far-reaching. The Federal Reserve, or the Fed as it's commonly called, has transformed from a simple lender of last resort into the central nervous system of the global financial order. But here's what most people don't understand. The Fed's power extends far beyond America's borders. When the Fed chairman speaks, markets in Tokyo, London, and Sao Paulo react instantly. When the Fed adjusts interest rates, emerging economies in Africa and Asia feel the tremors. The US dollar, backed by the Fed's policies, serves as the world's reserve currency, making the Fed's decisions matter to every person on this planet who participates in the global economy. Today, we're going to pull back the curtain and reveal exactly how the Federal Reserve changed the global financial game forever. Before we dive deep into this fascinating story, I want to hear from you. Do you think the Federal Reserve has too much power over the global economy? Should central banks be more transparent about their decision-making process? Drop your thoughts in the comments below. I read every single one and love hearing different perspectives. If you're finding this valuable, smash that like button to help this content reach more people who need to understand how the financial system really works. And if you haven't already, hit that subscribe button and ring the notification bell so you never miss our deep dives into the forces that shape our economic reality. Now let's get into it. The birth of the Fed and the problem. It was created to solve. To understand why the Federal Reserve matters today, we need to go back to an era when American banking was the Wild West of finance. Before 1913, the United States had no central bank, and the financial system operated in a state of chronic instability. Banks issued their own currency, there was no unified monetary policy, and financial panics erupted with alarming regularity. 1873, 1884, 1893, 1907. Each decade seemed to bring a new crisis that devastated ordinary Americans. The Panic of 1907 was the breaking point. It started when the Knickerbocker Trust Company in New York collapsed after a failed attempt to corner the copper market. Trust companies, which operated with less regulation than traditional banks, held deposits from thousands of Americans. When Knickerbocker failed, panic spread like wildfire. Depositors rushed to withdraw their money from other trust companies and banks, triggering a cascading crisis. Within weeks, the New York Stock Exchange had plummeted nearly 50%, dozens of banks and trust companies had failed, and the nation's credit markets had frozen completely. What saved the system wasn't the government. It was J.P. Morgan, the legendary financier, who locked rival bankers in his private library and essentially forced them to pool their resources to provide emergency liquidity to failing institutions. Morgan's intervention worked, but the message was clear. The United States could not rely on the goodwill of private financiers to prevent financial catastrophe. The nation needed an institutional lender of last resort. Congress responded by creating the National Monetary Commission, which spent years studying European central banking systems. The work culminated in a secret meeting in November 1910 at Jekyll Island, Georgia, where a small group of the nation's most powerful bankers and politicians drafted the blueprint for what would become the Federal Reserve System. The secrecy was necessary because banking reform was politically toxic. Americans had deep suspicions of centralized financial power, and previous attempts to create a central bank had failed. The Federal Reserve Act that eventually passed in 1913 represented a carefully crafted compromise. Instead of a single central bank headquartered in New York or Washington, the law created a system of 12 regional Federal Reserve banks spread across the country, overseen by a board of governors in Washington. This structure was designed to balance the interests of different regions, prevent any single financial center from dominating monetary policy, and give the system both public accountability and private sector expertise. The Fed's original mandate was relatively straightforward: provide an elastic currency that could expand and contract based on the economy's needs, serve as a lender of last resort to prevent bank runs, and supervise banks to ensure the safety of the financial system. In theory, when seasonal demands for currency increased, during harvest season, for example, when farmers needed cash to pay workers, the Fed could inject liquidity into the system. When those seasonal demands subsided, the Fed could contract the money supply. This flexibility was supposed to eliminate the boom and bust cycles that had plagued the American economy. But theory and practice are different things. The Fed's early years were marked by both successes and catastrophic failures. During World War I, the Fed helped finance America's war effort by purchasing government bonds, effectively printing money to fund military spending. This worked in the short term but planted seeds for future problems. In the 1920s, the Fed struggled to find its footing, uncertain about how aggressive it should be in managing the economy. Some Fed officials worried that low interest rates were fueling dangerous speculation in the stock market, while others believed the economy needed continued monetary support. Then came the Fed's greatest failure, the Great Depression. When the stock market crashed in 1929 and banks began failing in waves throughout the early 1930s, the Fed failed to act decisively. Instead of flooding the system with liquidity as a lender of last resort should do, the Fed allowed the money supply to contract by a third between 1929 and 1933. This catastrophic policy mistake transformed a severe recession into the worst economic disaster in American history, with unemployment reaching 25% and thousands of banks permanently closing their doors. Evolution of power, from stabilizer to economic architect. The Great Depression fundamentally changed how Americans and policymakers thought about the Federal Reserve. The Fed's failure to prevent economic collapse led to sweeping reforms in the 1930s that would eventually transform the institution from a passive provider of liquidity into an active manager of the entire economy. The Banking Act of 1935 reorganized the Fed's structure, centralizing power in the Board of Governors and creating the Federal Open Market Committee, which would become the Fed's primary tool for conducting monetary policy. But the real transformation came after World War II, when the Fed gained independence from the Treasury Department and began developing the sophisticated monetary policy tools we recognize today. The Employment Act of 1946 committed the federal government to promoting maximum employment, and over time, the Fed inherited responsibility for achieving this goal through monetary policy. The Full Employment and Balanced Growth Act of 1978, commonly known as the Humphrey-Hawkins Act, made this explicit by giving the Fed a dual mandate: promote maximum employment and stable prices. This dual mandate represents a profound expansion of the Fed's original mission. No longer was the Fed simply a lender of last resort designed to prevent banking panics. Now it was charged with managing the entire macroeconomy, keeping unemployment low while preventing inflation from spiraling out of control. This sounds straightforward, but in practice it involves making incredibly complex judgments about the state of the economy and the likely effects of policy changes. The Fed's primary tool for managing the economy is the federal funds rate, the interest rate at which banks lend money to each other overnight. By raising or lowering this rate, the Fed can influence borrowing costs throughout the entire economy. When the Fed lowers interest rates, it becomes cheaper for businesses to borrow money for investment, for consumers to take out mortgages and car loans, and for the government to finance its debt. This typically stimulates economic activity, creating jobs and boosting growth. When the Fed raises interest rates, it becomes more expensive to borrow, which slows down economic activity and helps prevent the economy from overheating and generating inflation. This might seem like simple arithmetic, but the reality is far more complex. The Fed operates with significant uncertainty about the current state of the economy, how different sectors will respond to policy changes, and what the appropriate level of interest rates should be. Economic data arrives with delays and is often revised. The relationship between interest rates and inflation has changed over time, and the Fed must constantly balance competing concerns. Raising rates to fight inflation might trigger a recession and job losses, while keeping rates low to support employment might allow inflation to become entrenched. The 1970s and early 1980s tested the Fed like never before. Inflation, which had been relatively tame in the post-war period, accelerated dramatically, reaching double digits. Americans faced the misery of stagflation, high unemployment combined with high inflation, a situation that conventional economic theory said shouldn't happen. The Fed, under Chairman Arthur Burns and then G. William Miller, responded tentatively, raising interest rates but not aggressively enough to truly combat inflation. Many economists believe the Fed was too concerned about triggering a recession and too willing to accommodate inflationary pressures. Everything changed when Paul Volcker became Fed chairman in 1979. Volcker made a historic decision. He would break the back of inflation no matter the cost. The Fed raised interest rates to unprecedented levels. The federal funds rate peaked above 20% in 1981. The medicine worked, but the side effects were brutal. The United States suffered through a severe recession, unemployment reached nearly 11%, and entire industries like manufacturing and construction were devastated. But inflation was crushed, falling from double digits to around 4% by 1983. Volcker's inflation-fighting campaign established the modern Federal Reserve's credibility. Markets and the public came to believe that the Fed would do whatever necessary to maintain price stability, even if it meant accepting short-term economic pain. This credibility became the Fed's most valuable asset. When people believe the Fed will keep inflation under control, they make economic decisions based on that expectation, which actually makes the Fed's job easier. Inflation expectations become self-fulfilling. If workers and businesses expect low inflation, they negotiate wages and set prices accordingly, and actual inflation remains low. The global dimension, how the Fed became the world's central bank. While the Federal Reserve was evolving domestically, something even more consequential was happening on the global stage. The US dollar, backed by the Fed's monetary policy, was becoming the dominant currency in international finance. This transformation gave the Fed power that extends far beyond America's borders, making its decisions relevant to billions of people worldwide who never elected its officials and have no say in its policies. The dollar's global dominance has historical roots in the Bretton Woods system created at the end of World War II. 44 nations agreed to peg their currencies to the dollar, which was in turn pegged to gold at $35 per ounce. The United States emerged from the war as the world's largest creditor nation and the only major economy with its industrial capacity intact. The dollar became the medium through which international trade was conducted, and the Fed effectively became the manager of the global monetary system. Although the formal Bretton Woods system collapsed in 1971 when President Nixon ended dollar convertibility to gold, the dollar's dominance actually increased in the decades that followed. Today, approximately 60% of global foreign exchange reserves are held in dollars. Nearly 90% of foreign exchange transactions involve the dollar, and most international commodities, including oil, gold, and agricultural products, are priced in dollars. When a company in Brazil wants to buy machinery from Germany, the transaction is typically conducted in dollars, not reais or euros. This dollar dominance gives the Federal Reserve extraordinary power over the global financial system. When the Fed changes interest rates, it affects capital flows worldwide. If the Fed raises rates, dollar-denominated assets become more attractive, pulling investment capital away from emerging markets and toward the United States. This can trigger financial crises in countries that have borrowed heavily in dollars. When their currencies depreciate against the dollar, the real burden of their dollar-denominated debt increases dramatically. We've seen this dynamic play out repeatedly. In the 1980s, Paul Volcker's high interest rates contributed to the Latin American debt crisis, as countries like Mexico, Brazil, and Argentina struggled to service dollar-denominated debts that had ballooned in real terms. In the late 1990s, the Fed's rate increases contributed to the Asian financial crisis, as hot money that had flowed into Thailand, Indonesia, and South Korea suddenly reversed course, triggering currency collapses and economic devastation. More recently, the Fed's interest rate policies have influenced the fortunes of emerging markets from Turkey to Argentina to South Africa. The 2008 financial crisis revealed just how central the Fed had become to global finance. When credit markets froze worldwide, it wasn't just American banks that needed emergency liquidity. European, Asian, and Latin American financial institutions were also desperate for dollars. The Fed responded by establishing currency swap lines with foreign central banks, effectively allowing them to borrow dollars that they could then lend to their own banks. At the peak of the crisis, the Fed had extended over $500 billion through these swap lines, acting as the lender of last resort not just for American banks, but for the entire global financial system. This global role has only intensified since the crisis. When the Fed launched quantitative easing, purchasing trillions of dollars in bonds to lower long-term interest rates and stimulate the economy, it wasn't just American interest rates that fell. Global interest rates declined as well, as investors searched worldwide for any assets offering decent returns. The Fed's balance sheet exploded from under $1 trillion before the crisis to nearly $9 trillion at its peak, flooding the global financial system with dollars and reshaping investment flows worldwide. Critics argue that this gives the Fed far too much unaccountable power over the global economy. When the Fed makes decisions based on American economic conditions, it may inadvertently create chaos in other countries facing different economic circumstances. An interest rate that's appropriate for the United States might be disastrous for an emerging market struggling with capital flight. Yet these countries have no representation in the Fed's decision-making process and no ability to influence its policies. The Fed's mandate is domestic, maximum employment and stable prices in the United States, but its impact is unavoidably global. Modern challenges and the future of central banking. Today's Federal Reserve operates in a financial landscape that would be unrecognizable to the officials who created the institution in 1913. The challenges it faces are unprecedented in complexity and scope, raising fundamental questions about the limits of monetary policy and the appropriate role of central banks in modern economies. As we look to the future, the Fed's actions today are writing the next chapter in the story of how central banking shapes the global financial game. The most immediate challenge is the delicate balance between controlling inflation and supporting economic growth. After years of historically low interest rates following the 2008 financial crisis and the COVID-19 pandemic, inflation surged to levels not seen since the early 1980s. Supply chain disruptions, massive fiscal stimulus, and rapidly changing consumer behavior combined to push inflation above 9% in 2022. The Fed responded by raising interest rates at the fastest pace in decades, from near 0 to over 5% in less than 2 years. This aggressive tightening worked. Inflation has moderated significantly, but it came with consequences. Higher borrowing costs slowed the housing market, made business investment more expensive, and created stress in the banking system, as evidenced by the failures of Silicon Valley Bank and other regional banks in 2023. The Fed faces the constant challenge of raising rates enough to control inflation without triggering a recession and mass unemployment. It's like trying to land an airplane in a crosswind. You need to make constant adjustments based on incomplete information, and the margin for error is razor thin. Beyond traditional monetary policy, the Fed faces questions about its expanded role in financial markets. Since 2008, the Fed has purchased trillions of dollars in government bonds and mortgage-backed securities, becoming a major participant in markets it once merely observed. This balance sheet expansion, known as quantitative easing, was necessary to combat the financial crisis and support the economy during the pandemic. But it also raises concerns about moral hazard. If markets expect the Fed to intervene whenever asset prices fall significantly, it may encourage excessive risk-taking and create the conditions for future crises. The Fed is also grappling with technological disruption in the form of cryptocurrencies and digital payment systems. These innovations challenge the Fed's monopoly on money creation and could potentially reshape how monetary policy is transmitted through the economy. In response, the Fed is exploring the possibility of issuing a central bank digital currency, a digital dollar that would exist alongside physical cash and bank deposits. This could improve payment system efficiency and financial inclusion, but it also raises profound questions about privacy, financial surveillance, and the role of commercial banks in the monetary system. Climate change presents another emerging challenge for the Fed. Extreme weather events, the transition to clean energy, and the physical and economic impacts of rising temperatures create new forms of financial risk. Should the Fed incorporate climate considerations into its supervision of banks and its decisions about which assets to purchase for its balance sheet? Some argue this is essential for maintaining financial stability, while others contend it would drag the Fed into political controversies beyond its mandate and expertise. Perhaps the deepest question facing the Fed is whether monetary policy alone can solve the economic challenges confronting modern economies. The Fed has incredible power over interest rates and financial conditions, but it cannot directly address issues like income inequality, declining productivity growth, aging populations, or the erosion of manufacturing employment. Some economists worry that the Fed has been asked to do too much, using monetary policy to paper over deeper structural problems that require political solutions and fiscal policy changes. Looking ahead, the Federal Reserve will continue to play a central role in shaping the global financial game. Its decisions about interest rates, its management of its massive balance sheet, and its approach to emerging challenges like digital currencies and climate risks will reverberate through markets worldwide. The institution created in response to a banking panic over a century ago has evolved into something far more powerful and far-reaching than its founders could have imagined. The Fed is neither the villain that conspiracy theorists imagine, nor the omnipotent savior that some expect during every economic downturn. It's a human institution, staffed by economists and policymakers, doing their best to manage an impossibly complex system with imperfect tools and incomplete information. Its decisions have real consequences for employment, inflation, asset prices, and the distribution of economic gains and losses. Understanding how the Fed works, what it can and cannot do, and how its power affects the global economy is essential for anyone trying to navigate the financial realities of the 21st century. The Federal Reserve changed the global financial game, and that game is still being played every single day.